Remember the late 90s when the internet was just taking off and dot-com companies were popping up everywhere? That was the dot-com bubble, an era of sky-high hopes and even higher stock prices. But guess what? We're in the midst of another tech revolution.
Of artificial intelligence.
Artificial intelligence.
Artificial intelligence.
Today we're diving into a fascinating comparison that's been on a lot of minds lately. Back in the 90s, if your business name ended in .com, investors threw money at you, hoping they'd strike gold. Fast forward to today, and AI is capturing everyone's imagination and investment dollars. But are we just reliving history? Or is this time really different? We'll also hear from our expert, who's watched both waves from the front lines, giving us insights into what really drives these tech frenzies, and how today's AI advancements compare to the .com craze. By the way, if you're new here, I'm Josh with Visual Sectors, and our goal is to gather data to help you use it to make better investment decisions. So buckle up, hit that like button if you're excited, and don't forget to subscribe for more deep dives into technology. Let's get started. Let's rewind to the beginning of the 90s. Remember when only 15% of American households owned a computer? Hard to believe that was only 30 years ago, right? But back then, personal computing was just beginning to find its way into everyday life. Companies like Microsoft were on the front lines, pushing the boundaries of technology to make it accessible for everyone. Fast forward to 1997, and things had changed dramatically. Now, 35% of American households not only had a computer, but were also exploring the burgeoning internet, tapping into its growing resources and services. This explosion of new technology, combined with easy access to capital, created a fertile ground for entrepreneurs. Innovators and visionaries now had the means to fund their projects and chase after rapid growth. The strategy: aggressive customer acquisition and market expansion, with a clear focus on capturing the market early. Investors, both individual and institutional, couldn't get enough of the tech sector. The promise of high returns seemed within easy reach, thanks to an abundance of easy capital that fueled risk-taking in tech startups. The game changed even further when the Telecommunications Act was passed, deregulating the telecom industry. This pivotal moment reduced entry barriers significantly, allowing internet service providers to flourish and expand more sophisticated online experiences and e-commerce platforms. By the late 90s, we hit peak dot-com bubble. It was an IPO frenzy, with tech company valuations skyrocketing to extraordinary heights. Take Netscape, for example. On its first IPO day, its stock price soared from $28 to $75 per share, a staggering jump for a company that wasn't even profitable yet. This opened the floodgates for a wave of IPOs and a surge in venture capital investment. The fear of missing out, or FOMO as we call it today, was real. Investors scrambled over each other, not wanting to miss out on what they believed could be the next big thing, even if those companies hadn't shown sustainable profits. Alan Greenspan famously called this period irrational exuberance, and he wasn't wrong. By March 2000, Nasdaq hit an all-time high of over 5,000 points, and prices were trading at 175 times earnings. But then, weaknesses began showing. The bubble was set to burst as major players like Dell and Cisco began massive sell-offs, triggering panic across the market. In just weeks, Nasdaq plummeted by over 30%, eventually dropping by 75% by October 2002. The aftermath was devastating, an estimated $5 trillion lost by investors. It wasn't just a market correction. It was a global disillusionment with tech that rippled through international markets. It took nearly 15 years for Nasdaq to claw back to its peak value, a sobering reminder of how bubbles can inflate and burst dramatically. Fast forward to 2024, and everybody is speaking about AI stocks. Everywhere you look, from YouTube to social media, you will see tens of thousands of videos explaining why you should absolutely invest in them. The fascination isn't just hype. Investors are genuinely intrigued by AI's ability to revolutionize industries, sparking a boom in AI startups and skyrocketing valuations. It's reminiscent of the dot-com era, with companies eagerly adding AI to their branding to capitalize on this trend. Interestingly, during the SB 500 2023 fourth quarter conference calls, AI was mentioned a staggering 179 times. This isn't just tech companies. Even brands like Heinz Ketchup are getting in on the action, showing just how important AI has become across different sectors. Take the example of OpenAI's ChatGPT, launched in November 2022. It quickly became a sensation with over 1 million daily users and 180 million monthly active users, making it one of the fastest growing web platforms ever. Due to its rapid growth and the rapidity with which it was integrated into users' daily lives, ChatGPT is often compared to a modern Netscape. However, despite the public excitement, professional investors are approaching AI stocks with caution. The memory of the dot-com bubble is still present, prompting a more measured expectation despite significant growth in the sector since 2020. Major tech firms have seen their valuations soar, but there's a conscious effort to keep speculation in check. Let's take Nvidia, which saw its stock jump an incredible 239% in 2023 alone, now ranked as the world's third most valuable company, with a market cap surpassing $2 trillion. Nvidia's success isn't just speculative. The company reported a 265% increase in revenue year over year and projects sales of $24 billion for the upcoming quarter. Yes, the investors see potential in AI stock, but the market seems to want to avoid the speculative excesses of the dot-com bubble. Lessons learned. By the way, if you want to dive deeper into Nvidia, you can find the link of our video about our predictions here. It's pretty easy to understand why the excitement around AI stocks is compared to the dot-com bubble. AI technology is revolutionizing industries across the board, from healthcare to finance. AI is set to turbocharge business efficiency and innovation. Companies that are embracing AI are not just growing, they're exploding in potential. However, we can see a difference in growth patterns. Let's compare Amazon in the 1990s to Palantir nowadays. In the late 90s, Amazon saw its market cap increase by 2,400% in just over a year. Impressive, right? But despite pulling in $2.7 billion in revenue by 2000, was still prioritizing growth over profitability. Now, let's look at Palantir. The data analytics company is often referred to as the next big thing. Unlike Amazon in its early days, Palantir has shown a more steady growth, a 360% increase in market cap, backed by solid profitability projections. By 2026, they're expected to hit $1.15 billion in revenue. It's not just about rapid growth anymore. It's about sustainable business models. This shift highlights how much investor expectations and market dynamics have evolved. Investing today is less about speculative bets and more about real, measurable business outcomes. We're not even in the same environment anymore. In the 1990s, only visionaries could see how much the internet would change our daily lives. Today, we can clearly see how AI will impact sectors such as healthcare, finance, and education. However, with the evolution of technology came some regulations, and the approach to a company's potential has to take into account every aspect of its business. We asked our expert, Brian Tancock, how professional investors are responding differently to this new hype.
Thanks, Josh. There are definitely a lot of similarities between the birth of the internet age 30 years ago and the beginning of the artificial intelligence age we're experiencing today, as new technology changes the way we live our lives. 30 years ago, the internet changed the speed and ease with which we accessed information, while today, AI is changing the way that information is applied to aspects of our everyday life, from self-driving cars to fully automated disease diagnosis and treatment. But one notable difference is the way that financial markets are responding to this new technological age. In the 1990s, the dot-com bubble was fueled by Wall Street's greed machine, as investment bankers were able to quickly monetize the hype around the internet. Following the success of the Netscape IPO in 1995, banks were eager to replicate that outcome, and virtually any company that had a .com behind its name became a candidate for immediate securitization regardless of the fundamentals. And the public was all too happy to buy what Wall Street was selling. And for the first time, they could buy it online without having to have a conversation with their financial advisor or even a stockbroker. If this all sounds a little familiar, well, that pattern replicated itself just a few years later, but this time with mortgages instead of internet stocks and yield-starved institutional buyers as customers instead of retail investors. As we mentioned, the valuations for tech stocks during dot-com were insane, as the NASDAQ 100 composite had a PE ratio of 175 in March 2000, which proved to be the top of the bubble. In today's markets, we're not seeing the same type of frenzy around AI that we saw for dot-com stocks, and there's one main reason for that: sophistication. The barriers to entry into AI are significantly higher than they were for internet companies 25 and 30 years ago. Google has spent the last 10 years and invested tens of billions of dollars into developing its AI infrastructure. And Nvidia has been designing and building GPUs for more than 20 years at this point. It's virtually impossible for a startup company to replicate that level of sophistication in a short period of time. As a result, we see that the winners of the AI revolution are concentrated among just a few names. So while an AI success story like Nvidia may be trading at more than 75 times earnings, if we take a broader look, we'll notice that only 5 of the NASDAQ's top 25 names currently have a PE ratio greater than 50.
Thank you, Brian, for helping us understand how professionals approach this new era of tech stocks. I think we can all agree that even though the excitement over the possibilities of the two periods can be compared, they are not on the same scale. The dot-com bubble was a first in its kind and served as a cautionary tale on the tech stock excitement. If you need any information on a specific stock, our new How Much Higher Can It Go widget will help you understand its possibilities. You can now benefit from a 7-day free trial by clicking the link in the description. And if you want daily financial news and opinions on stocks, follow us on Instagram. We post twice daily. Next week, we will talk about inflation and how to use it as an indicator in your investment journey. Don't forget to subscribe. You don't want to miss it. See you next time.